Today could very well be the calm before the storm. Now, is that going to be a short-term storm, or is it going to be more of a long-term pullback? So I'm going to break down from a technical perspective any kind of volatility we might get this week from what is a very busy week and how that can impact things. Today's trade idea is a stock that is moving. Despite the slow march the past few days, this stock is having a little bit of a breakout itself. So we're going to look at which one that is and how we can trade it. Let's go ahead and get started. Today is Monday, June the 11th, 2018. My name is David Settle. This is the Market Outlook from MarketScholars.com. Thanks as always for tuning in. Welcome to those of you who are watching us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel by mousing over the Market Scholars logo in the bottom right corner of this video. Click the red subscribe button that pops out when you do that. Like today's video by clicking the thumbs up down below the video here. That lets me know that you want us to keep doing these videos. Comment on anything that stands out to you. Join our Market Outlook daily email list. There's a link popping out in the top right corner that will help you to do that. Click on that link and subscribe. Follow on Twitter for more content that we put out there from day to day, and join our Market Outlook community on Facebook. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. We'll take a look actually at the cash index here. You can see it's small trading range today. It's a quiet news day. We got a big news week ahead of us. Coming out of the G7 meetings that we had over the weekend, where the possibility of having no tariffs at all was floated, as well as other things that had potentially could have had a negative impact on stocks. And you can see we did actually pull back late. We'll take a look at that here on another chart in a minute. If I'm going to get rid of this drawing, the Fibonacci lines. You can see the intermediate line here is strongly bullish. Easily in the upper, even with the pullback, even with that late pullback, which brought the near-term line down, the momentum line down, doesn't really matter. The near-term line is still in the upper reversal zone, which still supports a strong bullish posture. The momentum line did not fall. It can do whatever it wants as long as it doesn't fall to an extreme low point. That's the thing you're looking for right now on this bullish trend. The only thing you're looking for on the red line is, will it fall to an extreme low point? That's a kind of a red flag that the trend might change. In this case, no worries there. And again, the near-term line would not be surprising if it pulled back a little bit, at least even below 50 at some point, because we've got 9 days now. It's been above 50 this whole 9-day run, this big near-term run up to new higher highs. So pulling back to this old near-term high point here, where my cursor is, that would not be out of the realm of possibility at all. And obviously, as you saw before I moved the charts, that would be Fibonacci retracement zone for the S&P 500. We are approaching some old high points here from February and March, so it wouldn't be surprising if we run up with some intraday resistance here. I wouldn't put a lot of stock into that because we're trending higher. We've got market sentiment rising, so we've got a new good established trend. But don't be surprising if we hit some near-term weakness here this week, especially with all that's coming out, how the market may digest all that news. But any volatility wouldn't necessarily be impact the intermediate trend. You can see the Dow Jones looks very similar. The near-term line is pulling back. The NASDAQ, the near-term line had actually been weaker, had already pulled below 50, and we're bouncing up. So I actually wouldn't be surprised if we get a near-term divergence out of this. That wasn't very much of a pullback here. So here's the near-term run. Started off at this low. You had that near-term run. That's not much of a pullback. In fact, I would even venture to guess that's probably not even here's where the run started. Well, I guess it would be about 23% Fibonacci retracement pullback there. So yeah, that's a little bit of kind of a shallow exhale, and so don't be surprised if we pop back up here, especially coinciding with weakness in the next day or two in the S&P 500 and Dow Jones Industrial Average. The Russell 2000 did not fall below 50, but had fallen out of the reversal zone. It bounced back up today too. I wouldn't necessarily call this a near-term pullback yet, though, and here's the current near-term rally that we're on up to new all-time highs. So so that things still look very bullish. Shaded green obviously in the market forecast. The posture still is, no matter what the short term is looking like, the posture is still established in the reversal zone. So all's good, despite today's small range. And Mondays typically can be pretty light. We've got a lot ahead of us this week with FOMC and this North Korean summit with the U.S. and lots of different economic indicators. That's all on the docket, so we'll be checking that out and how that, what effect it has on price and how that impacts our expectations going forward using this study set and the other charts. All right, before we look at those other charts, a quick reminder for those watching the Market Outlook on the Market Scholars blog. Remember, below the video here is the Twitter, tonight's Market Outlook tweet, tonight's Facebook post, and then, of course, the green like button here on the blog. We asked for 3 clicks. The likes here on Twitter, if you have a Twitter account, those with Facebook accounts, a like right there with a thumbs up, and, of course, that thumbs up button. Those 3 clicks tell us you got something out of the video tonight. You want us to keep doing the videos. Tell us Twitter and Facebook that you want them to keep pushing you our content when we put it out there. And of course, tells them also that you think that other people should check this out, and they'll promote it to other people that watch or look for this type of content. Also remember too, if you haven't subscribed to our Daily Market Outlook email, you can do that too on this page. Okay, today's small range didn't change where we are in terms of the long-term chart. We're still shaded green, have been for over a year now, going on 2 years, that we've had the 50-day above the 200-day moving average. Both lines still rising. We're still easily above the 50. We don't expect it to get too far. Again, that move right there was so extraordinary that you're typically about that distance away. And that's currently where we're about at right now. So not surprising we're getting some near-term weakness from that perspective either, or at least expecting some near-term weakness. You can see the momentum continues to rise, which measures the gap down here between the 50 and 200-day moving averages. If we take a look at the 3 green arrow chart, again, 3 green arrows as evidenced by the shaded area here as well. We're above a rising moving average. We have positive momentum. The buyers are in control with the stochastics up here above 75. And of course, you can see that positive momentum on the MACD. When you look at the actual 2 lines, it is pretty strong momentum, but we're still above a rising moving average. Same thing with the stochastics. Even with this little weakness, we're still up above a rising 8-day and 17-day moving averages. So getting some distance away. Not, look for some short-term weakness. We've had a good near-term run. But any pullbacks we get typically last 1 to 3 days. We might bounce either off the 8 or the 17-day moving averages, and we'd expect to bounce up to off of a higher near-term low and the beginnings of a new near-term run to continue this intermediate trend that we're on right now. You can see that late drop was right at the very, very end. A lot of selling here coming in late on the S&P. You can see we did in the after hours. We have bounced up a little bit off of that 278.56, so we haven't necessarily stayed there. That puts us up just a little bit higher about in that area where my cursor is. But you do see we got a new 4-week high point today. The 4-week low is kind of in the middle of the charts. We've got some time before it moves over there. You can see that it's a pretty wide gap. The midweek 4-week midpoint is lining up with these old highs. So we got a lot of room for a near-term pullback, right? We can pull back into any part of this area here and just be fine. Here's your near-term rally. Remember, it was a 9-day near-term run on the SPX. So 1, 2, 3, 4, 5, 6, 7, 8, 9. There's that low point. So there's your 50% Fibonacci retracement if we did start here, and you're going to have your 38% kind of in this area. So we'll see, if it pulls back and how far it will pull back. That will probably be lining up most likely. Let's see. I would venture to guess, and let's snap these. Oops. Snap these to the open, high, low, and close. So if I were to put that down there and snap it up here to the very top. So in that area, you can see there's that 38% Fibonacci retracement. And if I were to throw on the 23%, that one's going to be right into that area, right where that low point is. So it looks like I had it nailed on. So there's where you're going to look for some pullbacks, and where you might find some resistance or some support, in that area, in this area, and ultimately at the 4-week midpoint. Again, anytime you're in the 4-week range, you're bullish in the short term. So we still got long term, the 2 intermediate term charts, market forecasts, the 3 green arrows, and now the short term, all still showing bullish signs. And remember, the volume today was a little bit slightly below average. The trading range is now easily falling below 1%, so that's bullish. The volume is low, and today's volume was even lower than that slightly. So bullish from that perspective too. You take a look at the volatility index and where it relates to the longer term volatility, and you're still sitting right at the 85% mark, which is that bullish zone sweet spot. All right, again, in summary, the current posture is bullish. The expectations are that the intermediate run will continue, but probably by midweek this week, especially with all that's on the docket here, a lot of this news risk could manifest itself into some short-term, very short-term volatility that may last 1, 2, 3 days. At least that's what you would expect it to last when you have a bullish posture like we do. And then we, again, forming a higher near-term low point, bouncing up. And none of these charts would suggest otherwise. None of these charts are even showing any kind of weakness yet. We don't have a red arrow yet on the 3 green arrows. We're still above the 8 and 17-day moving averages. Volatility is down into its bullish zone. So nothing would suggest that any weakness would be anything more than short-term 1 to 2 day pullback and looking for a new bounce. And this intermediate run still in this 1 month, so only has gone just a little bit more than a month, so it's still got another month or maybe 2 left before it runs out of gas. So what do you think? Do you agree or disagree with that? There's a poll popping up in the top right corner of your screen. Click on that poll and tell me, and do you agree with that posture? Do you disagree with it? Which definitely could be the case. And if that is the case, would love to hear what you're seeing that we haven't discussed. So just comment down below at the bottom of this page and let us know what bearish signs that you're seeing. If you take a look at how things performed today, you can see the biggest winner today, which had been one of the biggest losers, was crude oil over here on the left. EFA was also a big winner. It's been kind of lagging behind the S&P 500. In fact, there's only one thing over the last 2 weeks that have outgained the S&P 500, that's small cap stocks. So emerging markets gaining some ground again, small cap stocks also outpacing along with high yield. On the other end of the spectrum, agricultural stocks lagging behind, or agricultural's commodities lagging behind, and long-term bonds. Everything else pretty darn flat. I mean, look at the flatness you got here on EEM and preferred stocks and the dollar and the S&P. I mean, it's a quiet week in gold, a quiet week, quiet start to a week, to a busy week. And I mentioned, let's see here, nope, this one here, the busy week that we had. I mean, look at all the red dots, and this doesn't include the summit overseas that we have, and of course the Fed meeting here on Wednesday, which has impacted rate hike expectations. Of course, the rate hike expectations for June are about as high as they can be, so we're going to get a rate hike more than likely, according to the futures market here this week on Wednesday. You can see the odds of getting that another rate hike in September have jumped up dramatically today. A little bit of chatter that the Fed may start slowing down its tightening in terms of not raising interest rates, but in terms of letting these bonds expire and keeping the balance sheet at a higher level than what they had originally announced that they were going to dampen it down to. And so they might focus more on these short-term impacts rather than the long-term yields that were impacted by those rate hike, by those asset purchases that we had during quantitative easing. So the quantitative tightening pace is going to slow down. And that jumped interest rates, because that puts this as really the only way to tighten. And you can see the odds for another rate hike in December, so 4 for the year, jumped up to 45% from a lesser number on Friday. So pretty decent odds, and you can see that's what we have. And of course, the economic surprise index, which is so low abroad, still is relatively positive, small but positive in the U.S., and that's going to be, that's going to have an impact with all these data points that are due out over the week as well. Tomorrow, starting with the CPI, and then going through the PPI, retail sales, Empire State Manufacturing, industrial production, as well as the consumer sentiment survey that's due out later at the end of the week. So a lot of news, and that's going to impact these asset prices. But U.S. stocks continue to be the place to be, with weakness in emerging and weakness in developed. And you can even see preferred stocks lagging but doing well and outpacing even high yield, the high yield bonds, the corporate bonds. So everything else for the day, relatively flat, ahead of a, busy 2 days here that we'll have tomorrow and Wednesday. All right, when you look at the sector rotation, you can see, again, look at the biggest winner today, which kind of broke out on Friday and is breaking out a little bit more today, and that's the consumer staples sector. A lot of things are relatively flat, small losses in utilities and financials, which is interesting because they're both interest rate sensitive in the opposite direction. Everything else relatively flat. Energy bouncing back up a little bit. With a rising rising intermediate line. All the other intermediate lines, excluding financials, but materials and industrials and technology and discretionary and healthcare, they're all very, very strongly bullish, and real estate too, strongly bullish, whereas utilities, is the most bearish now. Kind of took the mantle over from staples, which has a strongly rising intermediate line now. It's finally starting to catch up to all the rest of these, passing the energy sector. So some renewed strength in that staples area that had been so weak, again, above a rising moving average now. In fact, they're all rising moving averages. They're all green, except for the red one here. The weakness really is in that utility area. No help today. In fact, if you get that daily market outlook email, you'll notice the clusters, in fact, all of the clusters in the S&P 500 right now on individual stocks are all coming from the utility sector. Make sure you sign up for that email if you want to see what those stocks are. All right, so when stocks are kind of, at least expected to be flat, and we're relatively flat today, and there's a lot going on. We've got stocks that are in bullish trends and are a little extended. I mean, we can get some pullbacks, like a stock like this, FedEx. FedEx broke out through its highs from last week today, so not a big move, smaller than the average range. You can see kind of breaking out of this volume profile over the past year into some areas where there's not as much volume. Up to its 52-week highs, but you can see a little bit of a breakout above the Bollinger Bands. The Bollinger Bandwidth is rising, so there's opportunity here. There's some obvious resistance around this blue line, which you'll see where it comes from here in a second, that can act as a support level. If you take a look at some of the other charts, you look at the market forecast for FedEx, and you can see strong bullish posture, just like the market. The near-term line getting up into the upper reversal zone, so bullish trend established with the market sentiment rising above its moving average. You can see it also has, I'll take a look at FedEx here, also has 3 green arrows. You can see it's rising up and then pushing up to new 4-week highs as well. When you look at the intraday chart here, there we go. Pushing up to new 4-week highs today, and again a little bit of a pullback that we had across everything late. And then finally the DMI, we'll take a look at the DMI index, evening star candlestick pattern showing up there on McDonald's. But you can see the DMI index with it crossing above 25 after being smidgen below 25 here, and there's still plenty of room to the downside for the DI negative direction, the negative directional index to go. And you can see the ADX is rising and close to crossing above 20, which would mean that establishing on a good trend. So again, with weakness expected, short-term weakness expected, we can look for the possibility of a bull put spread against selling that 35 delta, buying a strike price that's a little bit further out. And that gives us about depending upon where you get filled in, it's a relatively wide spread here, 15-cent spread on the long strike and a 20-cent spread here on the short. So it's an expensive stock. You're going to get typically wide spread. So you have to fiddle around with the pricing in here. You want to get at least 60 cents, because or 58 cents is the 30% return on risk. So if you can round it up to 60 cents, so anywhere above that would be great. So you just kind of have to fiddle in with the pricing there. And of course, you'll end up with relatively high probabilities, and then that break even, and even a little bit past it, because remember, we're trying for 69 bucks. We can lose 69 bucks, which is about in this area here, just a little bit below that break even. So that means as long as we hold support with this old resistance, which is a very, very strong resistance, so we finally broke through here, if we can hold that for support on any near-term pullback, great. just fine. And you can see there is some earnings coming up here later this month, about a week. So what that would mean doesn't mean that we can't do this trade. It means the odds of a max loss are higher. So if the odds of a max loss are higher on this vertical spread, then we will take a smaller trade than what we normally do. So instead of position sizing, for an example, up to 1%, if you see here, right now $180 is my maximum risk. So if I normally put, about 6 contracts here and put $1,000 at risk, then I'll do half of that as my normal trade, knowing that I've got a decent odds of a max loss. But even again, if we pull back, I've got that strong support level regardless of the earnings. So it'd have to be a significant move to get down to the downside. And any volatility drop, this is a negative Vega trade, so any volatility drop will not be, there we go. If it just switch this to, the max, you can see negative volatility. So any volatility drop, it won't be as bad. It will kind of mute a little bit of the losses here. You can see as I move my cursor over here, and you can see where the loss would be if I were to drop volatility. You can see that purple line moves up just a little bit, not much, but it helps smooth that a little bit down. Now you get across that threshold, which is where support is in this area, then that volatility turns positive. So a negative volatility will actually bring that line down instead of up. So just something to keep in mind with that earnings coming up, but it doesn't mean we can't do this trade. Otherwise, we wouldn't be able to do hardly any trades because there seems to be always earnings coming up. But the way you manage that risk, that increased risk, is take a smaller position than what you normally do. So as always, love to hear your thoughts on today's trade idea. What do you think about the market posture right now? What do you think about this week heading in? What's on top of your mind? What comments or questions did you have about today's video? There's a link that's popping out in the top right corner of your screen that takes you to our Market Outlook forums on marketscholars.com. Let's see what you think. Post your chats, post your comments, post your feedback. Post what you're seeing out there and anything you want to chat with other viewers of this video about as well. As always, thanks again for watching. Subscribe to our YouTube channel, like tonight's video, comment on anything that stands out to you. Follow on Twitter for more content and join our Facebook community, our Market Outlook Facebook community. Have a great evening, everybody. We'll see you all tomorrow.